Hi, I'm Sarah Clark-Ray. I'm a tax director at Wilson Partners based in our Maidenhead office. The biggest tax we tend to think about on separation and divorce is usually capital gains tax, or CGT. For CGT purposes, transfers of assets between a married couple or those in a civil partnership occur at nil gain, nil loss. I may say married couple throughout this video, but I do mean those in a civil partnership as well. Nil gain, nil loss effectively means that the person transferring the asset isn't subject to capital gains tax on the deemed gain arising on the date of that transfer, and the recipient gets the asset but with the gifter's base cost. Nil gain, nil loss doesn't get rid of the tax, it just kicks the can down the road until the recipient of the asset eventually does something with that asset. From April 2023, when a couple separates or divorces, nil gain, nil loss treatment has a time limit. So nil gain, nil loss will only apply for transfers made within 3 years from the end of the tax year of separation. Generally, that means when you cease living together as a married couple. Or there's no time limit if it's part of a formal divorce court order. There are specific tax rules regarding the matrimonial or family home. Usually when someone sells their main home, as long as they've lived in it for the entire period they've owned it and as long as certain conditions are met, any gain on sale is covered by private residence relief, sometimes known as main residence relief. A married couple can only have one main residence between them, so what happens when you separate or divorce? There's specific elections available, if conditions are met, to treat the sale of a main residence where a spouse has left and it's been sold on divorce or sold later down the line, so that they can still get main residence relief on the eventual disposal. So this really needs thinking through when one spouse leaves the home and it's either sold a long time later, perhaps when the last child turns 18. For the elections to be in point, the timings of the separation and the divorce and the transfers of the home to the spouse who remains there or a sale to a third party are really key. We can work alongside solicitors to ensure that the court orders give the right wording to get the right tax treatment. There are, of course, other things to think about when main residence relief might be at play. If the house is large or has land and outbuildings, then it may not be covered in full by the relief. Were there any periods of non-occupation that might be deemed occupation and therefore covered in full by the relief? Have any elections been made to declare a main residence? And has the home ever been used for business purposes? Although it might have been your main residence throughout ownership, certain conditions need to be met to get main residence relief. So we really need to kick the tyres on whether you're going to get them. It's not just capital gains tax that you need to think about on divorce, but the impact of owning the asset in the future. For example, income tax on any income generated on that asset and your inheritance tax exposure by owning that asset. At Wilson Partners, we can help you in all ways possible for divorce tax cases. We can run hypothetical capital gains tax calculations for transfers between you and the timings or sales to third parties. We can advise on tax-efficient transfers, elections available for main residence relief. We can undertake business valuations, analyse and advise on accounts preparation for property, investment or trade businesses, and also prepare formal reports for the court, such as joint expert witness reports. If you're going through a divorce or separation, I know tax isn't high up on your list, but please come and speak to us and see how we can help you.